The major markets saw some relief again last week, as 4 of the 5 indices closed higher. Emerging markets struggled yet again, as the impact of tariffs and an ongoing bear market in China weighed down the overall index. China represents over 32% of the MSCI Emerging Market Index. This is by far the largest single country and therefore a significant region to watch. Chinese real estate has been a strong component of economic growth in the Chinese economy in recent years. The rampant growth led to President Xi stating last year that homes are for living, not flipping. This past spring, some provinces moved to clamp down on flipping by requiring down payments as high as 70%, along with other tax prepayments. On Thursday, Bloomberg reported that a soon-to-be-published report will show roughly 22% of China's urban housing stock is unoccupied, adding up to 50 million empty homes. This comes at a difficult time, as the Chinese government has been trying to both temper the increases in house prices, while also stimulate their struggling private sector. Last week, the government began telling Chinese banks how much they must lend to the private sector. Going forward, at least a third of new loans must go to non-state companies. This type of action is unprecedented, as the country didn't even resort to such measures during the 2008 financial crisis. On Friday, Mike Pompeo met with Yang Jiechi in an annual meeting designed to improve relations between the two countries. However, little new ground was reached between the two sides. President Donald Trump and Xi Jinping plan to resume talks directly during the upcoming G20 summit in Argentina at the end of the month. Focusing back stateside, the S&P 500 saw gains at the beginning of the week ahead of Tuesday's midterm election. However, virtually all of the weekly gains were found Wednesday as the market responded to the forecasts of a split Congress, which became reality. While the balance of power shifted to the Democrats in the House, the number of seats that switched from Republican affiliation to Democrat was less than some had projected. As a result, the Democrats are unlikely to make significant changes to the recently enacted Trump administration regulations and tax policies. Later in the week, the FOMC meeting released their policy statement without any adjustment to the Fed funds rate. This was also an anticipated outcome. In the statement, the Fed continued to highlight the strong labor market, inflation, and continuing economic growth. October's volatility and market pullback, not to mention the ongoing US-China trade tensions, was notably absent, which gave even more indication that the Fed remains focused on the path to increasing the Fed funds rate in the future. As of Friday, the CME Group's FedWatch tool points to a 75% probability of an additional 25 basis point increase to the target rate following the December meeting. And finally, crude oil fell again as the S&P Crude Oil Index fell 4.6% this week. The fall from last month's 4-year high in WTI prices has been swift, as the commodity now sits in bear market territory. Concerns surrounding oversupply have quickly come into the commodity, setting crude lower again last week, marking the longest losing streak since 1984. This last weekend marked the 100th anniversary of Armistice Day, the end of World War I. While this war was originally known as the War to End All Wars, sadly, there have been numerous military conflicts since then. We'd like to express our thanks and appreciation to the veterans who provide us with our freedom and safety in this great country. Thank you for your sacrifice.